Alright guys, listen up, because this one hits home for a lot of people watching right now. America's got a growing auto loan problem, and it's not just a scary headline. We're talking record car prices, record late payments, and a surge in repossessions, the highest since the Great Recession. Today, I'll break down what's actually happening, what it means for your wallet and your job, and the practical moves you can make to protect yourselves. Let's get into it. What's going on? First, the basics. Car debt is massive. The Consumer Financial Protection Bureau reports that as of late 2024, Americans were carrying over $1.64 trillion in auto loans across 100+ million active accounts. That's one of the biggest buckets of consumer debt after mortgages. And since then, total household debt has kept climbing into 2025, according to the New York Fed. Translation: more balances, more pressure. Now layer on prices. In September 2025, the average new car transaction price in the US broke $50,000, first time ever. That's not MSRP marketing fluff. That's what buyers actually paid, per Kelley Blue Book. When car prices jump like that, loans get bigger, terms get longer, and monthly payments stretch you thin. And here's the stress signal you can't ignore. Subprime borrowers late by 60+ days just hit a record, over 6% per Fitch. That's the highest level in decades. Late is often the runway to default, and default is how you lose the car. Finally, the stat nobody wants to hear. Repossessions surged to roughly 1.73 million vehicles in 2024, up about 16% from the prior year, according to Cox Automotive, reported by Bloomberg. That's the most since 2009. If that trend persists, 2025 isn't going to feel any easier. Why this is happening and why now? Let's connect the dots. 1. Cars cost more. Supply shocks from the past few years never fully unwound in the low-end market. EVs and luxury trim skew averages up, and affordable new models have basically disappeared. KB's data shows the $50,080 record in September. When new cars are expensive, used cars are dragged up too. You guys end up financing bigger balances, often with less money down. 2. Borrowing got pricier. Higher interest rates make the same car noticeably more expensive to finance. Stretching to a payment number masks the real cost, but it doesn't make the math go away. 3. Households are stretched. The New York Fed shows household debt rising in 2025. When everyday costs bite, housing, insurance, groceries, auto payments start to slip for the most fragile budgets. And auto loans don't forgive easily. They repo quickly because the collateral is mobile and essential. 4. Risky loan structures plus negative equity. More people are rolling old debt into new loans and ending up underwater, owing more than the car is worth. The Washington Post highlights just how common negative equity has become. They cite average negative equity near $6,900, with plenty of people north of $10,000, plus a growing share of buyers with $1,000 plus monthly payments. That's a powder keg if your hours get cut or an emergency hits. 5. Cracks at lenders. We've already seen subprime auto lenders stumble. The tricolor bankruptcy and related charges at a major bank were a wake-up call. When lenders and the funding markets get jumpy, they pull back, which can tighten credit right when struggling borrowers need flexibility. Why this matters beyond car people. Losing a car in most of America isn't just inconvenient. It can cost you your job if you can't commute, and it raises all your other costs overnight. At scale, rising delinquencies can ripple through banks and bond markets that hold auto loan-backed securities. No, this isn't 2008, different market, different plumbing, but stress in auto credit is a classic early warning of consumer strain. Watch these indicators: subprime 60-day delinquencies, Fitch, New York Fed delinquency transitions, and repo volumes. If those keep climbing into 2026, you'll feel it in lending standards, used car prices, and even hiring. The playbook to protect yourselves, what actually works. This is the part most videos skip. Here's the practical, step-by-step game plan. 1. Buy with a payment-to-income rule, not a dealer script. Before you shop, set a hard cap. Your monthly car payment should be no more than 8% of your take-home pay, not gross. If you can't hit that with a reasonable down payment, you're shopping above your weight class. This keeps you from joining the $1,000 per month crowd highlighted in national reporting. Pair that with a target loan term less than or equal to 60 months on new and less than or equal to 48 months on used when possible. Longer loans can trap you in negative equity. 2. Pre-approve before you step on a lot. Credit unions and community banks often beat dealer-arranged rates. Get 2 pre-approvals so you have a real APR benchmark. Dealers make money marking up financing. Walking in with pre-approved terms forces the conversation to price and total cost, not what monthly payment do you want. 3. Kill negative equity right now. If you're trading a car and you're underwater, don't roll the shortfall into the next loan. That's how people end up $10,000 deep with nothing to show for it. Either A. Sell the car private party to maximize value, B. Bring cash to close the gap, or C. Keep the car longer and attack the principal with extra payments until you're even. The data this year shows negative equity is widespread. Your job is to not let it snowball. 4. If you're already struggling, call your lender before you miss a payment. Early outreach works. Ask about a hardship plan, temporary payment reduction, deferment, or a term extension to drop the monthly. Lenders prefer modifications over repos, and regulators track this space. The CFPB's focus on auto finance means your servicer knows they're being watched. Paper everything. If they offer a deferral, confirm whether interest accrues and how it affects your payoff date. 5. Refinance smart, but only if it lowers total pain. If your credit has improved or rates are better than when you financed, refinancing can lower the payment. Just don't extend the term so far you trap yourself in permanent negative equity. Use a break-even check if your payment drops enough to stabilize your budget, and you'll be right side up within 12 to 18 months. Green light. If not, look at selling the car and stepping down to something cheaper. 6. Don't let a temporary emergency turn into a repo. Build a mini emergency fund equal to 1 or 2 car payments. That buffer can keep you current through a surprise bill. Repo activity has already surged. You don't want to be in the next wave because a curveball knocked you 30 to 60 days late. 7. Know your state's repo rules and your rights. Repo law is state-specific. In many states, lenders can repossess without going to court if you default, but they must follow notice and sale rules. If your car was taken, request a reinstatement or redemption quote immediately and verify that the post-repo sale was commercially reasonable. If not, you can dispute a deficiency balance on your credit. 8. If you're in deep trouble, talk to a pro. A consumer law attorney can check for legal practices and help you negotiate. In extreme cases, Chapter 13 bankruptcy can halt a repo and set up a repayment plan. Chapter 7 may wipe unsecured debts so you can focus on the car, but it comes with heavy credit consequences. Get a real consult before you make that call. 9. For buyers right now, play offense on price. It's a weird market. Averages are up, but deals exist if you're flexible. Skip ultra-loaded trims, be open to prior year models, and comparison shop across a wider radius. Use the KBB fair purchase price and similar tools to challenge any market adjustment nonsense. Every $1,000 you cut up front matters more when the average new car sits above $50,000. The ripple effects. What to watch next? Here's your dashboard for the next few quarters. KBB average transaction price. If it stays north of $50,000, affordability pressure remains. Fitch Subprime 60-day delinquency index, a leading stress gauge. If it keeps setting records, more repos are coming. New York Fed household debt and credit look for transitions into 90-day delinquency for auto loans. Rising transitions equals worsening risk. Repo volumes. The 2024 jump to 1.73 M was huge. If 2025 stays elevated, lenders will tighten further. News on lenders, bankruptcies, or big reserve builds are canaries in the coal mine. Bottom line: you guys don't need fear, you need a plan. The facts are the facts. Car prices hit a record, delinquencies are at multi-decade highs for subprime borrowers, and repossessions jumped to levels we haven't seen since 2009. But you're not powerless. Cap your payment to a sane slice of your income. Pre-approve, shop hard, and refuse negative equity traps. If you're wobbling, call the lender before you miss. Get a modification in writing. Know your rights if a repo happens. And if you're buying, get surgical. Trims, prior year models, broader search, and walk away if the math doesn't respect your budget. Do this and you'll stay in control regardless of what the next headline says. Alright guys, that's all I've got for today. If this video opened your eyes even a little bit, do me one favor and smash that like button, drop a comment with where car prices are at in your area, and of course hit subscribe so you don't miss the next one. Stay smart, stay ready, and I'll see you in the next video. Bye. Sources used: latest CFPB auto finance research, New York Fed household debt and credit, Q2 2025, Kelley Blue Book, September 2025 pricing, Fitch subprime delinquency readings, Bloomberg/Cox automotive repossession totals, reporting on negative equity and $1,000 plus payments. Citations throughout the script link to each data point. consumerfinance.gov.